gotta leave your money behind you.
Welcome back to another episode of Gimme Some Truth. Dan in the studio, joined by Nate. And Nate, we have two very special guests with us today to talk real estate in Madison, real estate more generally. I'll let you do the introductions of our very special guest today.
Yeah, we had you talk first because we teased your radio voice to these guys. And so if that wasn't, paid off with an actual, Dan snippet, then, we built it up for nothing. So
exactly.
There you go. We have Charlie Wills, all-star real estate agent in Madison, Wisconsin, and Ryan Smith, same all-star mortgage broker here in Madison, Wisconsin. These guys are the best of the best in our opinion, and we've used them, both Clint and I, personally, and couldn't have better things to say. So we're going to talk about the real estate market and just kind of what's going on. We get a lot of questions in terms of, is this the right time to buy? It's now into the fall. Should I wait till the spring? What are rates going to do? Everybody tries to look at a crystal ball, and unfortunately, that's difficult to do, as we know. So, Charlie, why don't you kick it off and just let us know kind of, I would just say the current state of the market, if you will, today, right? We'll go from there, but let's start with where we're at today.
Sure. I think we're in a normal, if that's a key term, a normal fall market. We've seen the peak of the market pass. It always peaks, let's say, end of July, beginning of August, and has a little bit of taper off just due to family vacations for summer activity, right before school starts. We have a little bit more activity through September, and now we're into October where we'll see kind of that drop off and that slow kind of fade into the holidays where we'll see a really big drop off in activity.
Okay. Ryan, help us out with where we're at currently in the mortgage market.
Yeah, well, first of all, thanks for having us.
Oh, you're welcome.
Love doing this and being with you guys. Yeah, I agree with what Charlie's saying from a real estate flow. It does feel like a little bit more of a normal market compared to last year, which was anything but normal. As far as the mortgage market, we're seeing a little bit of an uptick in interest rates. When I say that, rates are still phenomenal, but when people have their mind set on rates at 2.6 or 2.7 on a 30-year fixed and they go to 3.1 or 3, that's a raise in interest rates that piques people's interest. So the trend and all people who predict interest rate flow are saying that interest rates are going to be rising a little bit here. We've seen that in the last month, actually. So right now we're hovering around 3%, give or take a little bit, depending on the loan and the client's situation. But we're still seeing a lot of people buy homes. One of the things we're seeing a lot of people do, and I think is the right thing, is people are getting prepared.
Sure.
And if they're not going to buy right now, they're getting prepared for winter. They're maybe hearing that the inventory or the competition is different in the winter, so it might be a great time to buy. And they're getting prepared for next spring. So we always encourage that. I think Charlie, as a realtor, would encourage people if they ever want to buy a home, they should get prepared. And so right now, fourth quarter is a great time to get prepared for people.
Yeah. I second that. Preparation is good for a multitude of things, right? It sets you up for something really good in the future, that if you don't choose to do it now, you know what your position is to move forward. But if you do choose to move right now, you're going to be ahead of everybody else who's going to scramble and then try to compete with you maybe at that point. So preparation's key.
Yeah, it's almost one of those where there's not really a negative, right? I mean, like you said, even if you kind of get yourself ready to go and then don't end up moving on what you thought your plans were going to be, maybe your house is in a little better shape. Maybe you have a little less clutter in your house. Maybe you know a little bit more about your finances than you did before. So not really a negative to getting yourself prepared.
There really isn't a negative. I will address a negative that people ask me a lot about. It's probably the most common question I hear as a lender is it bad that we run your credit now and then you'll need to run it again when you buy? The answer is no. Obviously, you don't want to do a lot of it, but it's the only way you can get foolproof prepared. So don't be afraid of that. It's normal to have your credit run, and it's customary to do so. And if you have it run again in 4 months, which is the lifespan of a credit report, that's fine. It's not going to hurt you. It gives us as lenders a full look into your situation. We can see your finances, we can see your debts, your credit, everything we need to see to advise you to get prepared and be ready to go.
I think back to the days that I did what you did, Ryan, back
Many moons ago.
Many moons ago. Yikes, aging myself. Danny just snickered, youngin' in the room. You always had that kind of weird, cable bill that you didn't pay from college, right? From, $38 that's on your credit report, you didn't know it was there. And if you try to deal with that, closing within 30 days because you didn't prepare yourself, that can, something even as small as that can create some major problems.
Yeah. And something that's different now than when you helped people with loans is that your credit score is a direct indicator of what your interest rate's going to be. So
sure.
If you did miss a Cap 1 bill that's $38 because you had an annual fee on there and you didn't realize it and so you didn't pay it, that's going to hit your credit score. And that could impact your interest rate, which then impacts your home affordability for the life of that loan.
Yep.
So I encourage people, let's take a look at it, because credit, if there is something that isn't perfect, it's not a life sentence.
Right.
And I think sometimes people think that it's, that's kind of their identity, and it's not. We can fix it. We can, the reality is you can't fix a problem until you know what it is. So the preparation on that is key. So anyways, going back to how we started this, it's people are buying homes. People are going to capitalize on what is going to be a slower traffic few months here, which is a good thing for a lot of people. And if not, at least they know where they're headed and they know what their plan is for the spring, the summer, whenever it is that they want to buy.
Yeah, Charlie, I think we all had the question written down on our kind of prep sheets here for the podcast. The idea of, should I buy now, right? Or the whole idea of, well, I didn't find what I want and the market is quote into the slower time, so therefore I will wait till spring. Mm-hmm. What are the thoughts there?
I go back to Ryan's preparation. If they've prepared, let's talk about that, right? Like, where are you? What's the market going to do? So we tell the story. So right now, if you were June, that buyer was, let's say, assumably in the market in June, and they couldn't find something from then until now. They experienced probably on average, let's say, a dozen offers. They were competing every single time. That's exhausting, right? You know that you're going to have to bring your best game. You're writing at least, let's say, 5 to maybe 10% over every single time. So what we're preparing them now is, you may still have to write full price, maybe a little bit over if you're competing with maybe one or two, but also if you don't want to compete right now, we're setting, like, here's an example of like things that we're doing, like the concern. We had somebody just say, like, I'm tired of competing. Don't put me in those situations anymore. How do we do that? And we were just sitting down trying to brainstorm, and we thought, all right, we're going to look at every single house that's over 10 days on the market.
Sure.
It's through its first full week. No offers are accepted. Maybe the seller's second guessing what they did.
Yep.
Let's go take a look. And now we're starting to get 2, 3, 4% off of that list price. And they're not competing. And they're like, how do we get 3%? I'm like, it's just timing, right?
Yeah.
Like, you're prepared, which is amazing. You went and saw our good lender partners at Guild. And now we have what we need. We can put a really good package together. And let's make it clean. If you're going to ask for 3% off, don't do an inspection. Give the seller something to want to take that offer.
Yeah,
right?
absolutely.
So it's that kind of stuff that I think you'll see through the end of the year, where people will get some, I don't want to call them deals, but they're not gonna have to negotiate against themselves.
Yeah. My father was in real estate for a long, long time, and he always used to tell people that, literally homes will sell every single day of the year. 365 days, a home will sell. A home will sell on Christmas. A home will sell on Easter. Like, you can't, so the idea of, either A, I'm a seller, so I'm gonna not list until the spring, right? Nobody can buy it if it's not for sale. Or B, I'm a buyer, I'm gonna wait till spring because nothing will be on the market. I mean, somebody's gonna buy something the end of December, and they probably get a pretty good deal at that point.
And showing my age, when we first started, we had MLS books, which is
I remember
awesome.
those.
No
Yeah,
data.
right.
It was just in a book that everybody fought over and made copies. Now we have these amazing data analytics that we can show. Like, we just had a person contact us. It's $800,000 house. You would think probably not a smart time to be putting that house on the market. But if you look in their neighborhood, there's nothing for sale, and everything in that price range sold in about this much time.
Sure.
So you can show all the data and then let them choose. What do you think? Right? And here's the graph from January to December of last year and January through September of this year.
Sure.
Tell me what you think that looks like and what you want to do. And they were like, let's put it on the market, because there was nothing for sale. So I think you have to, like, there's general statements. I think Ryan and I make a lot of general statements just because that's like the average of the market. But depending on each person's situation, I think there's very specific data that could make them sway one way or another if you just show them the information.
Yeah.
Which I think speaks to what we were talking about as what seems to be developing as a theme is preparation. If I'm interested in selling my home, it's $800,000, and I'm going to come to you because you're somebody that's going to give me the data and the analytics to realize that, okay, if it says right now is not a good time to sell, when is, based on the trends and the data, and so let's list when that is. And again, if you get prepared and the data says let's do it now, then follow the trends.
Yeah. Let's switch gears a little bit. Ryan, I think we've been in this market for so long that I think there's people that have lost sense and lost kind of their compass, if you will, in terms of what used to be a normal mortgage rate, right? So let's go back to when, you and I first met, 15 years ago, whatever it was. I mean, a normal rate at that time was what? Give me a range.
Yeah, so my career started in November of 2000.
Okay.
9/11 happens, and I believe before 9/11 rates were in the sevens.
Sure.
If I remember right, it was 7.3, 7.5, something like that. 9/11 happens, and since that day, interest rates have gone down.
Sure.
So my whole career, 21 years, has been in a low, quote unquote, rate environment with a few blips in between there, right? So before COVID, rates were in the mid fours. They'd gotten up into 4.5, 4.75, and then COVID hits, which none of us knew about or expected, and now we've gone all the way down into the mid twos and now back into around 3%. So a normal rate, that's a hard question to answer because I don't know if there is such a thing. I would say a normal rate in the last 10 years or a range is 3% to 4.5.
Yeah.
But historically, if you look at the history of interest rates, I wish we had that graphic, but it's a downward trend.
Yeah.
And over the last 50 years with a few little blips in there. So, there's every one of us has, parents that talk about when they bought their first house, which was 18% or 16% or whatever that is. But in my 21 years, 6 months before 9/11 was the highest rate that I've seen since then.
And that was mid sevens.
Yeah.
Yeah.
Yeah. So, they went to 5.5, and that was a huge deal. Then they went to 5, then 4.5, then 4, and then they go back up a little bit, and then they go back down. So, but for a range, we've been in a 3 to 4 range or 3 to 4.5 range for a long while.
And I wanted to kind of lay that out because I think people contextually, lose sense of kind of, as you were saying before, oh my God, it went from, 2 5/8 to 3, and they're hitting the panic button, and rightly so. I mean, I understand why, but at the same time, I think we have to understand kind of where they were and how good, relatively speaking,
I would say that the thing that I pass along to my clients is it's such a blessing for all of us to own homes at these interest rates.
Right.
Because it's just, if you look at 3% versus 6, for example, which is 3%, it's massive. And of course, home prices were different when rates were higher, so that's all relevant. But
by massive, you mean payment significantly higher?
Yes, of course.
Total interest paid significantly higher.
Over the life of a loan, we do an analysis with our clients to look at what is the difference between this rate and this rate over 5 years, 10 years, however long you tell me you're going to be in the home.
Yep.
And let's look at it. Well, if we were to take rates from when I started or 10 years, whatever it was, yeah, it's double, know, and that's a blessing to be able to give you money and invest it and instead of putting it all into mortgage payments.
Right. Because somebody's getting that money. It's just, it's the mortgage company. Right. You're not getting it, and so, I hate to go down this path because it always leads us into a spot where we can look silly. But 2022, guys, what do we think?
I think before we get there, I think it's good to tell a little bit of a story. Going back to Ryan's, I'll only go back to 14. I started in 2003, but I think what makes it relevant now is like the new era of like what has been happening with prices and rates.
Sure.
That's kind of when the slide happened, looking back at the graph of data. I'll talk from like a price perspective, inventory perspective. Since 2014, the median sale price in Dane County was $219,000.
Wow.
What is today?
Oh, man. 385?
Close.
365.
Yes. 365.
65.
Think of that. That's a 73% increase in value.
In
I think,
7
right?
years?
No, 60%.
In
60%.
In 8 years.
In 8 years, 60% increase in value, 73% loss in inventory. So when you have inventory shrinking at such a rate that you can't even build, so all the new builders that are here,
Right.
they're building 2,000 to 3,000 homes a year. They cannot ever catch up, ever. No matter how many homes they build at that rate, they'd have to build 10,000 homes plus a year.
At that rate, if everything, all the other variables stayed constant.
Correct.
Yeah,
Correct.
yeah, right.
Yeah.
Right.
They'd have to do that forever. They'd have to build 10,000 homes because we're like millions of homes under inventory in the entire United States. So just in this area, I mean, that shows you that difference. So if you look at that history, right, what's happening, if we play the devil's advocate here of what's going to happen in 22, we just ran a scenario, and there might be a math finance nerd that's going to call me out on the wrong math here. So I apologize if my math isn't specific enough.
None of this is guaranteed. We're saying that right now. Danny heard us. That is not guaranteed.
Not guaranteed. It's a little asterisk underneath my comment here. So if we take that mentality, and typically prices have been going about 6.5% to 8% increase. So let's just take the low end of that. If prices go from 350, let's say, and we add 6.5%, that puts them at 371,000 plus, right? Much more in the value in 1 year. Now the rate, let's say the rate ticks from 3 to, let's say, I have it written down at 3.7. It was predicted by Lawrence Yoon, who's the chief economist for the National Association of Realtors. He said by summer to fall of 22, he believes the rates are going to be that much up. And he had a bunch of factors of why. But if you look at then your payments, so from a price increase and also a rate increase, you're going to go anywhere from $100,000 to $118,000 more in interest over the life of that loan for waiting.
Sure.
So when we have that discussion with a buyer, I think it's really easy to say, like, this will most likely happen. I don't know if it's going to be both scenarios.
Sure.
But if even one of them happens, the price goes up, you're another $90K less in value that you take because you're paying out of your pocket in interest. So, right. I think that's a really great story to be able to share. And I'd love to hear the money side from Ryan, because that is not my world.
Yeah, one thing that I would share with people, and again, disclaimer, this might not be entirely exact, but I'm pretty sure that every year of my career about this time, all people who predict what is going to happen to interest rates and markets have said that rates are going to go up next year. And I'm not saying that they're not going to. I do believe that they are going to. But there are a lot of things that can happen and that do happen that cause the opposite effect to happen. So, if you look at the realtors, the bankers, Fannie Mae, Freddie Mac, they all put out publications of where rates are going. And they are predicting that interest rates are going to rise. We're starting to see it right now. And they're across the board from what I've seen from 3.4 to 3.7. And that, they'll even talk about where they think they'll be in 2023. But again, there's a lot of things that happen between now and then. But the trend is upwards. But again, if we go back to historically, you're talking about mid threes, low fours, let's say, versus, 6, 7, 8, 9, and beyond. So that's what I'm hearing. And I echo everything you said about the cost of these homes. The inventory is the driving force and the hot topic in the market right now. One thing you said earlier that I wanted to highlight for those listening is that
Intrigued.
What's that?
I'm intrigued.
Yeah, is that there actually are homes that are on the market 10 days without a contract on.
Yeah, right. Yeah, exactly. Is that a thing?
Flash news.
We kind of passed over that, but
Is that a thing?
that is a big deal because for those of us who have been in real estate or finance or have been our clients who have tried to buy homes, a home without a contract in 10 days of listing did not exist for the last
2 years,
almost 2 years.
But to that point, so if you go back like last year, the year before that, was this time of year, call it fourth quarter that we're entering into or into now right now, was that was it as hot in fourth quarter of 2020 and 2019 as it was? I mean, obviously the springs were that hot, but I mean, were the falls and the winters that hot as well?
2019, not as much.
Okay.
2020 was on fire. Never stopped.
The entire year.
Yeah.
Okay.
As soon as April,
January.
let's say April-ish, the market
Yep.
was like, okay, we understand-ish what COVID is, but let's get going. The housing market can explode.
Sure.
And, it went hot through all of this year.
Sure.
And it just stopped in August.
So you're just seeing the slowdown now.
Yeah, we thought, oh yeah, man, December's coming, January, historically, this is what's happened.
Nothing.
No.
Just kept rolling.
We did as much business in December and January as we were doing in June.
Oh, that's insane.
And it was nuts because we were closing 20 to 25 homes a month. And you're like, how can this continue? This pay, like we were all, I don't want to sound like a complaint. It's not a complaint. It was more of a, how does this sustain was more of the like question in all of our minds. So when, our team has been seeing a little bit of a slide off and people, we were like, woo, a little bit inside, you're like, all right, 18 months, we went really hard. This little pause here is a really great way to have those conversations. And, speaking of the, hey, in 10 days, you might not going to have an offer, flip that to your sellers and prepare them.
Sure. Right.
Just so you're aware, we're going to do all we can to get you multiple offers. Most likely what we're seeing, not going to happen.
Sure.
So just so you're aware, you're going to probably be for sale for 2 to 3 weeks. We're going to get an offer. It's probably still going to be great. Maybe get 2. But we're not in the environment right now where we're going to get 10.
Sure.
So do you want to do it now or do you want to wait?
Yeah, it's the psychology of the cycle. I think that's going to be one of the biggest challenges in the market is, everyone's so used to the traffic and the timeliness and the prices that when things come off of that, sellers are going to have high expectations that aren't going to be met sometimes. And so, doing a great job of giving them the data and what they can expect is going to be really important because for those of you who are listening and maybe have been looking at buying a home and have struggled, what I would say is this quote-unquote slow that we're seeing, which is still a very healthy flow of clients, this is the time. And one thing that I would say is I've seen in the last month and a half, many of our clients that were frustrated last year or this spring and said, forget it. I'm done with this. I'm frustrated. I can't get my offer accepted. They're coming back with accepted offers because they're walking into a home on a Saturday of a Badger game and the market's a little slower and they're writing an offer and getting it accepted. And that did not happen for them. So I would encourage, again, going back to the beginning, preparation is key, having the data and maybe, getting back into it and seeing what's out there because we're seeing a lot of people that were frustrated have a lot of success right now.
Interesting. In the last couple of minutes that we have, kind of give us an idea of what you think that, even maybe just the first half of 2022. Again, it's difficult to predict, but are we looking at neck break again speed? I mean, is it whiplash time again, or is it a little bit more of like, no, it'll be a controlled frenzy? We'll say that.
Man, traditionally, spring is always breakneck. No matter the market conditions, it's usually just nuts. It's February through about July. It's just fast.
Yep.
It's beautiful out. People have been pent inside for 5 months. It's time to get out, spread your wings. So I think that is normal and that will be there. The thing I'm curious about, and I'd love to hear Ryan's thoughts or even yours, is that the environment that we're in, we're short on everything. And we talk about this a lot with our clients. Like if you're a seller looking to prepare your home right now, we need 2 to maybe 4 months to order stuff for you with a contractor, even to get a contractor in here. First of all, it's going to take 2 or 3 weeks just to get them in the door to get a bid. And then from there, once you sign a contract, it's going to take a month or 2 to get your materials. So now you're talking, we're already in January before we even start repairing your home. Like think about that. It's months to get a basic repair. So I think the market will continue to just have this that backlog feel to it.
Yep.
It'll be pressure based. It'll be high and intense. We have a term in our office, we call it the hurry. Like everybody's in a hurry, but you can't go anywhere. You're in Chicago traffic and you're raging that you can't get anywhere, but it doesn't matter because you're not going anywhere. Right. So I think if you can at least have the conversation about that with people, hopefully it helps them get prepared. But I think it's going to be a little nuts.
Yeah, I would agree with you. And going back to data, I've been studying a little bit on what are people predicting is going to happen, to try to get ready for next year. And, they're predicting that refinance activity, which is the second, wheel of our business, is going to be down dramatically. And I saw different predictions of 50 to 60%. Refinance activity will be down, which happens in a rising rate environment, right? But the good news is that purchase activity is predicted to be up 6.8%. So to answer your question, just based on predictions from people way smarter than us, or from me, I should say, excuse me.
No, you can throw me in that boat.
are that the purchase market is going to be up, and so will it be as frenzied or breakneck, so to speak? I think in Wisconsin, coming out of winter, to echo what Charlie said, I think you'll see a lot of activity building up in February, March, and I think you'll see a lot of people out in the market. That's why, again, preparation, get prepared for it, maybe seek an opportunity when other people aren't out there, and if not, be ready for next spring.
Yeah. Well, let me just take the last minute we have here and just say a couple comments on this. And again, my background tends to skew towards real estate, and my contention is if you're in a market the way it is right now and you are not working with experienced people that understand the trends, that understand what's going on, if you're not working with people that have teams behind them, like Charlie and Ryan do, you're doing yourself a disservice. This is not an advertisement for Charlie and Ryan. It's just saying get yourself with people that understand how these transactions go together. Experience during these times it's beyond invaluable. You have to work with people that understand what they're doing. Your ability to get that house, if there is a multiple offer situation, or to get yourself in a position where you are seen slightly better than maybe the next buyer, is crucial. And so, there's still the whole argument of, but I have to pay for that service and blah, 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 whatever. Hey, pay for service. It's worth it. You will get the value in the end. And if you don't work with people that have a good understanding of what they're doing, unfortunately, you'll save a little bit of money on the front end and you will pay for it long term. And that's just not a spot you want to be in. So I thank Charlie and Ryan. Danny, with your magical radio voice, why don't you take us out?
Thanks for having us.
Yes, thank you.
Great.
Well, thank you guys all for joining me in the booth. This was a great lesson for me, just sitting here and basking in all of your knowledge. So thanks again for listening. Make sure to subscribe to us. We're on Apple Podcasts, Spotify, wherever you get your podcast. Until next time, this has been Gimme Some Truth. Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit WalknerCondon.com.